right, so here we are, Chapter 11, Part 2. If you're listening to this video, then you've made it to almost the end of the semester. And this is the very last topic that we'll discuss before we start reviewing for the final. So here we go. All right, so we've talked before about the character of income, and specifically the character of gains and losses. All right, and so this slide kind of sums things up, but it also introduces the last topic that we're going to discuss, and that's section 1231. Okay, so remember really that when we talk about property, we have to pay attention to its holding period and then its use, and those things are going to determine how we tax the gains and losses on that property. Okay? And this is another slide that gives us more details. Okay? And this is a slide that has a fantastic amount of information, so I encourage you to find this in the ebook. All right? And then let's recap things a little bit. All right? So let's talk about ordinary assets. Okay? So you've got several examples of things that would be classified as ordinary assets. Okay? So assets created in a taxpayer's business. All right? Business assets held for less than a year. And so what are good examples of these things? Whoops. Inventory, receivables, all right, those are great examples. And then we have things that are capital assets, all right? And so remember that we have, whoops, there we go. Assets held for investment, for the production of income or for personal use. Okay. And then remember too that classification depends on the purpose. Okay? All right. So we also then have C corporations. And we're not going to deal with C corporations nearly as much, but remember when you're talking about C corporations and capital gains and losses, that works a little bit differently than with individuals. Okay, but that is not the focus of our conversation currently. So what we need to talk about are 1231 assets. Okay. All right, so this slide kind of sums up the big ticket items for section 1231. All right, so let's talk about each of these items. So what are potential 1231 assets? Well, potential 1231 assets are depreciable assets and land used in a trade or business held for more than a year. Okay, so already you have to have essentially business property that's been held for more than a year. All right. If there's a net 1231 gain, then that's treated as long-term capital. If there's a 1231 loss, then that loss is treated as ordinary. So from a tax perspective, these two pieces are very beneficial to the taxpayer because your gains are taxed at preferential rates, but your losses are ordinary. So that's fantastic. There is a caveat, and that's this one right here. So the caveat is potentially your 1231 gains this year could be recaptured or recharacterized as ordinary income depending on the depreciation recapture rules, and we have this thing called the 1231 look back rule. And we're going to talk about all of these items. I'm going to do a couple of examples in this discussion that will hopefully help clarify all of these things. The book has a pretty long discussion of all of these items, and there are lots of other pieces that we are not concerned about for this course. All right, so I've included this little slide in our discussion because it talks about the asset types. And so 1231 assets really consist of three potential types. Land is considered a pure 1231 asset because it cannot be depreciated, and so it's considered a pure 1231 asset. Personal property and intangibles are called 1245 assets, okay, and that's because of the Internal Revenue Code that describes their treatment, okay? And then you have 1250 assets, which are depreciable real property. For the most part, we are not concerned with these rules for this class. The focus of our discussion is going to be on 1231 and 1245, okay? All right, so now let's talk about why we care, okay? Back. All right, so when you sell or dispose of 1245 property, so this is personal property, you encounter one of three scenarios, okay? You recognize a gain solely because of depreciation deductions. You recognize a gain created through both depreciation and actual asset appreciation, or you recognize a loss, okay? So you've got those three situations, all right? And so what I'd like to do now is talk about an example that kind of explains these three situations, all right? So I'm going to talk and write here. So we're going to assume in 2017, McFessel Company purchases a Jeep for use in our landscape business, all right? Jeep costs $35,000, okay? All right, so She uses the Jeep in her business, sells the Jeep in 2019. So what would she have done? Well, she would have depreciated the Jeep So a Jeep is 5-year property. So her depreciation in 2017 would be $7,000. Her depreciation in 2018 would be $11,200. And then in 2019, remember this is going to be half-year property. And so her depreciation in 2019, the year she sells the Jeep, is $3,360. All right. So total depreciation taken over the life of that Jeep is $21,560. Okay. So in 2019, I'm going to switch the colors here. Adjusted basis of Jeep 2019 is going to be equal to our original price minus our depreciation taken, which is going to be equal to $13,440. Okay? Now, let's assume all right, so we sell the Jeep in 2019 for $20,000. All right, so now what is our gain or loss? All right, so we have amount received is $20,000 minus our adjusted basis equals $13,440. And so what do we have? Well, we have a gain of $6,560. Now the question is, what is the character of this gain? All right, well, the answer to that is based on what is the use of this asset and how long did we have it. Okay, so was this asset used in our business for a year or more? Yes. So this was business use for more than a year. So it's potentially Section 1231 gain. All right. But what do we have to do? Well, what we have to do is we have to look at the amount of gain and where did that gain come from? All right, so let's take 1 minute and we're going to pull back everything and we're going to look at our beginning facts. All right, our Jeep originally cost $35,000 and we sold it later for $20,000. All right? So we sold it for less than we bought it for. If we had not depreciated that asset, we would have sold that asset at a loss. But since it's business use property, we got to have the advantage of depreciating that asset over the last 3 years and enjoyed a tax break via that depreciation deduction for the last 3 years. And what that did was reduced our adjusted basis. So now, instead of that asset generating a loss, it generates a gain. If this gain were to automatically be treated as a long-term capital gain, then that would potentially be double dipping. All right. And we can see that in this situation, our total depreciation that we took through the years is $21,000, over $21,000. Our gain is less than that total amount of depreciation. So all of this gain was generated purely by the fact that we depreciated this asset over its useful life. So we can't treat this gain as capital. All right? So what that brings us to is kind of situation one. If okay, so in this situation, if the gain on the sale is less than or equal to the depreciation taken, then the gain is taxed at ordinary rates and called an ordinary gain. So that's exactly our situation here. This $6,560 gain would be taxed at ordinary rates. It would not be considered Section 1231 gain. It would not be given long-term capital treatment. It would be taxed at ordinary rates. Okay? Now, let's look at a different scenario. So let's say now we'll change our facts up just a little bit. All right, so now let's say by some magic twist of fate, we are able to sell this Jeep for $40,000. All right, so instead of our Jeep depreciating in value, for some reason it was a limited edition Jeep, and it held its value very well. In fact, it appreciated, and so we're selling the Jeep in 2019 for $40,000. So now, what is our amount received? That's $40,000. What was our adjusted basis? We're going to assume same adjusted basis, same depreciation. So now our gain is $26,560. Okay, so now we have the same basic question. What is the character of this gain? Okay, Well, just like last time, we have to look at this gain with respect to the amount of depreciation we've taken. So our gain is 26,560. And the amount of depreciation we took throughout the year is $21,560. $21,560. All right, and we can see that our gain is larger than that depreciation. So now what do we have to do? Now we have to recapture the depreciation taken. All right, so what does that mean? So that means we're going to break this gain up into two pieces. So this gain is now getting broken up into two pieces. One is this $21,560, and the other is $5,000. So the amount of the gain has not changed, but we've broken it up into two pieces. So this $21,560 is taxed at ordinary rates. This is depreciation recapture. That other $5,000 is gain that we had because the asset actually appreciated in value. That is not gain that we're experiencing because we were able to depreciate that asset over its life. So this $5,000 is Section 1231 gain and taxed. Oops. At capital rates. Okay? So those are your two gain situations. We also could have a situation where there is a loss. So our third situation we have to consider is, what if we sell property at a loss? All right, so what if we sell it at a loss? Okay, so say we sell the Jeep in 2019 for $10,000. Can't imagine why we do that, but let's say we do. We sell the Jeep in 2019 for $10,000. So our amount received is $10,000. Our adjusted basis is still the same. And so now we have a loss. And we have a loss of $3,440. So how is this loss treated? Well, this is the cool thing. So since this Jeep was business use property used in our business for more than a year, this loss gets treated as an ordinary loss. Okay? So That's pretty cool. So that gets to be netted against your ordinary income and is not limited to that $3,000 a year deduction like a capital loss would be. So those are the three scenarios for Section 1231. All right, let's talk brief. Hold on, let me go about Section 1250 property. Okay, so Section 1250, there used to be depreciation recapture for real property. Okay, that has pretty much ended, except for in the case of C corporations. All right, and in C corporations, it's called Section 291 depreciation now. All right, because there's a different code section that talks about it. And so it's a very specific rule. Under Section 291, C corporations selling depreciable real property recapture as ordinary income 20% of the lesser of the recognized gain or the accumulated depreciation. So if you had a large amount of accumulated depreciation, you're only going to recapture 20% of that. Again, this is not the focus of our discussion, because we are mostly concerned with individual taxation here. All right, so let's look at another example just to make sure we've got everything squared away. So we've got a machine with an adjusted basis of $6,000. We're going to sell it for $10,000. It gives us the amount of depreciation we've taken on the machine, what amount of gain is recaptured as ordinary, and what amount is 1231. Okay, well, what do we have to do? We have to look at what we received, and our adjusted basis, and we got to figure out our gain. So we received $10,000. Our adjusted basis was $6,000. So we've got gain of $4,000. All right. Is this gain larger than our amount of depreciation taken? And the answer is yes. That is larger than our $2,500 of depreciation. So we know we have some depreciation recapture. Okay, how much depreciation do we have to recapture? Well, let's look at our gain minus depreciation. All right, so our gain, whoops, is $4,000 minus $2,500. This is our depreciation recapture. The leftover equals Section 1231 gain. And this, so this is taxed at ordinary rates, and this is taxed at long-term capital rates. Okay? All right, so there is one last wrinkle. And the last wrinkle is called the Section 1231 look-back rule. Okay? And what this means is you have to look back 5 years. All right? And what you have to do is look back 5 years and see if you were able to deduct 1231 losses as ordinary losses. if in the last 5 years you've deducted Section 1231 losses as ordinary, then any of your Section 1231 gains that you would like to recognize are recaptured as ordinary. All right, so hold on, let me write that down. And then we'll do examples of this when we do our practice problems in class. But I want to get this look written down. So what this look back here does is you're going to look back 5 years. If in the previous 5 years you have deducted 1231 losses as ordinary, then you must reclassify 1231 gains as ordinary income instead of as capital gains. Okay? So that completes part 2 of chapter 11, and we'll do some examples in class. Thanks a lot, guys.